to this discussion where we're going to be looking at the Knight Frank Wealth Report 2021. We've got an expert panel lined up to bring you the key findings from the report, including Liam Bailey, Global Head of Research at Knight Frank. So it's terrific to have Liam's insight with us today, alongside Majid Hussain from Smith & Williamson, to give us a tax aspect on what's happening. And also we have Mark from JTC in Jersey, who's going to give us the fiduciary and property view. So looking forward to a terrific 50 minutes of discussion ahead. We've got two audiences, as always, for these sessions. We've got an audience with us on Zoom and a broader audience as well, joining us live on YouTube. Both audiences are able to submit questions for our panel to discuss as we move through. So do get your questions and comments into the chat, and I will bring them to our panelists live as we move through this discussion. But just to open us up, to get this discussion underway, I'm going to come to Sarah May Brown, who's a partner at Knight Frank Private Office in London. Welcome, Sarah.
Thank you very much. Thank you, David. Thank you for having us today and inviting us to come and talk to you.
Pleasure as always.
With you.
So, Knight Frank have been producing the Wealth Report for 15 years. Why don't you tell us a little bit about, why the business does it, what it looks at, and why you think it's important?
Yeah, thank you. Yeah, we're 15 in our 15th edition this year, and it's our flagship research publication. Knight Frank, obviously a big global business covering both residential and commercial property, but actually that's probably the key really in why this is important. Looking at our own client base, but ultra high net worths in general, the vast majority have mixed asset real estate portfolios of both residential and commercial property, and those can stem across geographies, across different asset classes. And I think for many principals and family offices and also for their advisors, trying to navigate getting the relevant research together and market intel together to be able to make the right strategic decisions for their portfolios, and obviously private, their residential homes, their very personal acquisitions, family members going to university overseas, whatever it might be, navigating that picture as a whole is incredibly difficult. So for us as a global consultancy business, it's something that we put together really with that aim to sort of help provide that type of insight at a high level. The report itself, as you say, 15th edition this year, probably more relevant than ever to look at the wealth and global property. And the report itself looks at the trends in private wealth growth and distribution around the world, the risks and opportunities in private wealth, and then moving over into the interplay with private capital, with residential and commercial property markets. So on the residential side, we primarily look at the top 100 performing residential markets around the world. And then on the commercial side, we look at the trends in commercial investments and see what's currently playing out. And in addition to that, we look at philanthropy, we look at luxury spending trends, which is always a bit of fun to benchmark that, particularly against residential property investments. So the report is, where are we? Compiled by 50 our research teams across 50 countries around the world, and in doing so we also interview our own clients and close to 1,000 wealth advisors who collectively represent around $3 trillion of private capital. So that's really where we're coming from with it, and why it's important to us, and why we feel it's hopefully beneficial to clients.
Great. And within the private office team, you deal with clients and with intermediaries. You deal across the piece with professional connections as well as those investing in property.
We do, absolutely, yeah. Private clients, family offices, multifamily offices, advisors across the board. My particular remit is the Channel Islands.
Okay.
So I'm in and out of the Channel Islands, hopefully a bit more so now.
Perfect. So without further ado, and to get into some of the details, I'd like to welcome Liam Bailey, Global Head of Research at Knight Frank. Good afternoon, Liam.
Good afternoon, and thank you for the invitation to be on your session today.
Pleasure.
I think just following on really from what Sarah was touching on, this year's Wealth Report, as Sarah said, our 15th edition. We've been pulling the report together over the last few years and really exploring the impact of wealth on property markets in particular, but also on other asset classes as well. So if it works for this session, I was going to spend sort of 5-10 minutes just running through some of the key points from the report, and just to sort of start our debate today, if that works for the team. So fundamentally, our starting point is looking at an understanding of the growth of wealth and how investment from wealthy individuals is driving markets or is influencing the performance of markets. And over the past 12 months, our research findings revealed a really interesting kind of dynamic that we were in the midst of the pandemic when our report was being shaped. And our wealth sizing model revealed that over the last 12 months, the numbers of ultra high net worth individuals at a global level expanded by 2.4%. So there's more than 520,000 individuals with more than $30 million or more in investable assets. And the reason I think there's two sort of takeaways from this. One is the fact that we've had this sort of rapid expansion of wealth, particularly out of Asia, but also out of Europe and North America. And it kind of reinforces the point that really it's a kind of it's almost it's a very similar story to the one we saw during the global financial crisis. So, lower interest rates, more fiscal stimulus has pushed asset prices and has pushed demand, and that's helped to lift portfolios and generate wealth for a growing number of individuals. And on the kind of flip side of that is the fact that actually this generation of wealth by wealthy individuals during the pandemic and also the kind of the economic crisis that we were seeing in the midpoint to the end of last year into the beginning of this year was taking. So that was this growth in wealth was taking place against a backdrop of rising economic difficulties and also rising government spending. As governments look to mitigate the worst impacts of the pandemic. So one of the other things that we've been looking at in the report this year is how governments might respond to this growth in wealth and this growth in wealth inequality in many parts of the world. And actually, one of the things we touch on this year is that growth of wealth taxes. There are existing or proposed plans in place in a diverse range of locations like Argentina, Canada, South Korea. It's part of the tax discussion in the US at the moment. So it's a very live issue, and again, something we look at in this year's report. The other issue is around the built environment. So we look at urban centres and cities in some detail. So we saw cities certainly in the sort of the mid to latter point of last year as being kind of bearing the brunt of COVID. So lots of CBDs closed down in Europe and North America particularly. Retail seeing significant risks and significant problems. And also we were seeing reports of wealthy residents leaving urban areas and moving to rural or suburban locations. And this is particularly the case in the US and actually even arguably in the UK as well. So what we've been looking at really is actually that narrative, but also looking at some counter narratives. So just to touch on the most recent data we have from the London market, is that actually the numbers of new applicants or new registered buyers looking to purchase property in London has hit not record highs, but actually levels above the 5-year average right now. So we're beginning to see an uptick in demand in places like London, and actually some of the recent work we've been doing with our New York colleagues confirms that same story. So the numbers of tenants in the prime market of New York has hit a 10-year high in the past 3 months. And as cities spark back into life and as lockdowns ease, we are seeing a notable improvement in terms of demand for prime markets for sales of property, but also in terms of rental property as well. And that just touches on a third theme from the report, which is around residential property and the performance of residential property. I mentioned that asset prices have been lifted through the pandemic, and we've seen in many parts of the world a significant and substantial residential price boom across many of our markets. It's reflected in the mainstream market, it's reflected also in the prime market as well. I mean, markets like New York have seen price falls over the past few years, but actually suddenly in the past 2 to 3 months, those falls have reversed. Prime London has seen price falls since 2016, and for the first time in May, we've suddenly seen annual price growth turn positive. So there's a significant shift in those prime markets, but actually at a global level, many of the markets that we cover from New Zealand through China and Hong Kong, Singapore, etc., are seeing some really strong price upticks on the back of savings have increased for many buyers, interest rates have reduced, and also, of course, the economic backdrop has improved significantly over the past 2 to 3 months as economies begin to come out of the lockdown period. Just touching on the commercial property sector, we've noted that in the past 12 months, whereas the institutional sector, so the kind of the pension funds and the investment funds, reduced their exposure to residential property investment by around 6%. Actually, the private investor, the private wealthy investor, saw an increase on their 10-year average in terms of the amount of money that they've allocated to property. And one of the key findings from this year's report is actually an expectation that that will continue this year. So probably around 25% of very wealthy individuals globally expecting to invest more money into commercial investment property over the course of the next 12 months as they spy opportunities for generating income, and particularly important in the low inflationary environment that we're in at the moment. Finally, as Sarah's touched on, we look at a broad range of other assets. We look at luxury investments, and some of the performance has been very strong. So some of the collectible sectors like handbags, whiskey, wine, etc., performed very strongly. The art market stuttered slightly last year because the public auctions were closed and delayed, and the private sales were difficult to host. But the art market is beginning to improve in terms of sales volumes and also pricing in some of the subsectors. But again, it's really the report is reflecting a growth in demand from investors at a global level in assets which can generate income, where there's the potential for adding value through, say, refurbishment or improvement, certainly in terms of the property sphere, and actually the ability for investors to stock pick either locations or actually individual properties and individual opportunities to try and improve the performance of their overall portfolio. So I hope that's a good whistle-stop tour and summary of the contents. So back to you.
Just on the inflation point, I mean, you mentioned that we're in a benign environment at the moment, but there is, there's inflationary pressures building. You're seeing that coming through in the media now. I mean, what's your expectation of if inflation in the UK, for example, got going and then rates had to rise? What kind of impact would that have on those owning property with debt, either at the residential or in the commercial space? But how would you kind of factor that into where we go forward?
I think it's probably, if it's probably the critical question right now. I think the commercial and residential property markets have seen a growth in value over the past decade, primarily because we're in a ever lower interest rate environment. That appears set to continue. The central banks certainly and most commentators seem to be relatively relaxed that actually inflation should be a transitory, if that's the right word, phenomena, but actually if inflation does become set in our economies, then and the banks have to, central banks have to respond, then we have some significant risk, because actually pricing has been set by the fact that debt is so cheap right now. The only kind of counter to that is, or there are several counters to that. One is the fact that the past 15 years has seen a significant reset in the way that central banks have been managing risk amongst banks, so that banks are more capitalized than they were back in 2008 before the last financial crisis, and also regulation from central banks, which has fed through to mortgage providers over the past sort of 10, 15 years has been around trying to mitigate some of those risks from last time round, i.e. reducing high risk lending, so high loan to values, etc. So to try to actually improve the resilience of the lending environment. So that should provide some mitigation to any sort of future risk. I think if the worst case scenario happens and we see a significant uptick in inflation and rates have to rise, let's say more than 1%, say in the UK or in other markets, then you would have an impact on capital values. I think it's unavoidable. It's just that scenario doesn't seem to be the central scenario right now.
Okay, thank you. In terms of London's picture in the world, I mean, I'm sure this was brought out in the report. Who competes with London? Is it on our time zone? We're the capital here, and you've got New York, you've got Singapore on different axes. How do you see the global picture versus other cities?
I think when it comes to global wealth and its attractions to city markets, London is sort of unique. I mean, it's not completely unique, but you've got other markets which are attracting wealthy individuals for specific reasons. So places like Monaco and other kind of wealth hubs because of taxation policy, and really that's their rationale and really why they exist. But in terms of big business hubs and sort of financial hubs, New York's different because it's just got such a much bigger domestic market to draw on. Whereas London is a much more globalized market, so it's a much more diversified market, much more reliant on flows of global wealth. And actually, in terms of other marketplaces, Singapore, Hong Kong, Dubai, etc., they are just much more. They're important, but they're much more regional plays. They have much less of a kind of global relevance than the London market does. And actually, if you look at London as a city economy, it really is unique globally. There is nowhere where you see the same density of financial, business, tech power that you see in London. I mean, certainly Silicon Valley and New York are bigger tech centers than London, but actually London is the third biggest tech sector in the world. It's arguably either first or second in the world in terms of financial services. And it's in terms of clustering of universities, research and development, it's also got many other strengths. So it does have a unique proposition, despite things like Brexit and other recent changes. They really haven't been damaged.
Okay, thank you, Liam. If you have any questions for Liam, please put them in the chat, and I will bring him back on and put those questions directly to him. But I'm just going to turn now to Majid Hussain from Smith & Williamson. Welcome, Majid.
Hi, David.
Liam discussed there some of the trends in wealth inequality that Knight Frank highlighted in the report through the pandemic, and potential impacts UK taxpayers might face if the government needs to shore up its finances. What's your view on where we're at with the tax picture in the UK? What potential changes might there be for high net worth clients coming down the track?
Well, I mean, firstly, David, thank you for having me on. I mean, I think the tax piece is really interesting. Just, I mean, parking the UK for a moment, I think we've got a global issue. Countries, economies across the globe have been trying to fight this pandemic. So I think there's a global point, and then there's a slightly more local point in respect to the UK. I think just picking up a couple of points that Leah mentioned and that come up in the Knight Frank report as well is the issue of wealth taxes potentially being on the horizon. Now, I think there was a lot of discussion around this, especially around the last election here in the UK, and it's kind of reared its head again, albeit briefly. We've had the comments from the Wealth Tax Commission, which suggested having a one-off wealth tax in the UK. We don't think that's going to have very much traction. If I'm entirely honest, I think ultimately it's going to be a political choice, and it's not one that's going to come very easy. But that said, I think if you take a look at the UK tax landscape, changes are already happening. I expect there will be more changes to come. If you just take corporation tax, for example, we've already had announcements that's going to increase. What's been really interesting, and especially for everyone that's on this call, from a private wealth perspective, I mean, we're going to see an increase in corporation tax to about 25%. But with potential kind of exemptions for smaller companies. But actually that doesn't apply to family investment companies. It doesn't apply to structures that are surrounding private individuals or private wealth. So I think there immediately you can see a potential impact for our clients and for the landscape. I think the other piece in the UK has been what was issued recently by the Office of Tax Simplification. And the real big question was around aligning capital gains tax and income tax. And as you can imagine, that would be a huge increase in tax take for the UK government. But arguably, I think that's something that, from a perspective of an advisor and for those people that, that deal in this type of area, it's something that we should be considering. I think it's something clients should be considering. I'm not saying it's going to happen immediately, but I think there's definitely an appetite now in the UK and also in the US of taxes increasing, and we've had it in the Biden announcement. They are going to be increasing capital gains tax. They're also going to play around with private equity. So I think there's, in terms of taxes, I think they're very much on the horizon. I think they're going to happen. I think the messaging is there. So I think it's definitely one to watch.
And do you think with those recent corporation tax announcements on a global scale, trying to increase the minimum level of corporation tax could actually create opportunity for the UK? Because if the gap is closed between headline rates, perhaps more companies would decide, well, the benefit of being in the UK outweighs the small differential. Do you think there's anything or how do you read those global initiatives around trying to harmonise corporation tax rates?
I mean, interestingly, I think that's welcome news from the UK. We've had announcements from a domestic perspective that corporation tax rate is going to go up. I think from if you were in the government right now, you'd be quite happy that actually there's going to be a minimum rate across the globe. So that makes if we thought we were going to be less competitive, that reduction has gone. So I think that's probably welcome news from a UK tax perspective.
Okay, terrific. And focusing in on the real estate side, I mean, what's the latest position for international investors looking at purchasing UK commercial or residential property in terms of the structuring, the tax considerations that they're typically going through with you at the moment?
I mean, David, if I was to say, if there's one area in the UK that's probably had the most significant tax changes over the last 7 years, it's going to be UK real estate. I mean, we've seen 8 charges. We've seen the introduction of non-resident capital gains tax. We've seen that start on residential property. We've seen it move to commercial property. We've seen the introduction of inheritance tax for non-res, non-dom individuals on UK residential property. So, I mean, there's been a sea change in terms of taxation for UK real estate. I think that most people have seen, and we have, as advisors and clients have experienced. However, all said and done, I think from a UK tax perspective and seeing what our clients are doing, I think we are still seeing, the UK being an attractive place for real estate investment. I mean, I know from our clients, one of the key things is that actually this has put the UK on a levelling playing field. Most jurisdictions tax real estate regardless of whether you're resident or non-resident. So I don't think that significantly changed the market as such. Yes, it had short-term impact, but I think in terms of, are we still competitive globally? Yes, we are. are we seeing clients making inward investment? Yeah, we absolutely are. And I think there's a slight trend in terms of, and again, it anchors a bit into what Liam's mentioned in his report and what we're seeing with clients. There does seem to be clients looking beyond London to get better yields. That's been an interesting insight for us in terms of what our clients are doing, especially in commercial property. They are looking beyond London and some of the other kind of centres in the UK to find better yields effectively.
Okay, thanks. And are you still seeing clients investing and then actually residing in the UK? So not just the pied-à-terre that they're buying in London to give them an option if they're in the Middle East or India or wherever, but actually deciding to become a non-dom and move to the UK to become tax resident here. What are you seeing?
Interestingly, actually, I've seen over the last 18 months, we've seen more, I think, inward movement than outward movement when it's come to residents. I mean, we've got clients effectively where I would say putting their money where their mouth is, taking advice and actually becoming UK tax resident. And I think the piece around that is, obviously we speak from a tax perspective, but ultimately, actually, one thing that has been demonstrated over the last couple of years is that clients are really looking for stable jurisdictions, stable jurisdictions where they can do business, where they can live. And we have seen a significant, change, especially from clients around the Middle East, looking not just to come to the UK as a holiday home, but actually looking to establish themselves more in the UK as residents, as citizens, family coming over more. So that's definitely been a trend that we've been seeing a lot more, and especially from particular regions such as the Middle East.
Okay, terrific. Well, thank you, Majid. Just to bring Liam back in quickly, on the stamp duty front, Liam, I mean, there have been so many changes. Rates have sort of escalated for those top-end properties. What impact do you assess that has? And obviously, we've had the holiday as well, which creates market movements. What's the Knight Frank read on how the stamp duty impacts demand in residential property?
Well, it's a negative.
Sure.
I think there's two things really. I think one is, I mean, we saw a significant impact on pricing back in 2000 and sort of 14, 15, 16. So the big change was made late 2014, which was when George Osborne sort of had the biggest reform of stamp duty, and then we had another with the additional rate of stamp duty came into play in April 2016. So from those two kind of points, we saw prices in the prime London market fall 25% from that point. And some of that was down to sort of Brexit uncertainty, but a significant amount was around stamp duty and the way the market had been shifted in terms of its tax treatment. So there is always, I think, if you tax an activity, then you'll generally see less of it, and you'll also see some repricing, and we've kind of experienced that. But I think that at the time, to be honest with you, the biggest, I think the biggest negative was the fact that we never got, I think under George Osborne, we never seemed to get to a point where he was happy with where he'd kind of moved things to. So there was such a period of intense change, and that created uncertainty. So every kind of 6 months, you had the kind of the autumn statement, the spring statement, and there was another change, whether it was ATED or stamp duty or whatever. So that level of uncertainty caused a real sort of disjuncture in the market, because actually developers, for example, looking to develop into the prime sector and deliver prime property into central London, when they're bidding for land, when they're bidding for their sites, developing, etc., they had no idea really when they delivered the stock, actually what the tax environment would be for purchasers. So it became a very uncertain environment, and property taxes haven't been reduced at the top end, apart from the current stamp duty holiday, but we do appear to at least have moved away from that period of extreme uncertainty around taxation, which I think was probably more damaging. To be fair, we speak to HMRC regularly, and we speak to the Treasury and so on a regular basis. You can't second guess where these things could go. I think it's probably unlikely that we'll see a significant reform of property taxation. I know that it's out there as a thought. I know the Treasury are interested in looking at land taxes and all sorts of other sort of options, but it doesn't seem to be a priority right now. I think the the biggest impact at the moment on the stamp duty holiday has been to drive volumes across the market, and that does include the top end of the market. Even if you're in the very sort of top of the market, you still rather say £15,000 than not. But I think when I look at our latest data in terms of registered buyers, so people looking to purchase property right now, those volumes have increased again in the past 4 weeks compared to kind of 3-year average, 5-year average. And none of those people registering in the last 4 weeks will be able to buy before the end of this month, when the big taper begins on the stamp duty holiday. So there seems to be a kind of a momentum in the market, despite the fact that the current stamp duty holiday is disappearing. So I'm relatively happy that the market will stay strong post end of this month, and certainly past the September deadline.
Okay, thank you. Just to bring in Mark Fleming from JTC in Jersey. Good afternoon, Mark.
Good afternoon, David. Thank you for having me on.
Pleasure. So just looking in a bit more detail on the sort of commercial property side and what kind of activity you're seeing. We heard from Liam, opportunities are now presenting themselves around redevelopment, city centre commercial properties. Already clients are spotting opportunities there. Are you starting to see any trends in activity in UK commercial real estate in this respect?
Sure. Well, if I just kind of rewind briefly just to around this time last year, I guess a lot of our clients in that period were really kind of thinking short term, and we're looking at what was kind of COVID, what was COVID going to do for them and for their businesses or their structure that they have with us, and we saw a lot of negotiations with banks around covenants, negotiations with tenants, and indeed we still do have some negotiations with tenants that are ongoing. So it was really kind of somewhat in kind of firefighting mode to an extent at that period. But then kind of as the kind of year unraveled, I started thinking more strategically about what the opportunities would be within the kind of, not just within real estate, but outside of that. Yes, that's certainly starting to happen. And as an example, got a kind of structure where there's a hotel group, and there's opportunities to maybe kind of go into a hotel in a city where we're not present, so at a kind of discounted rate. So there's certainly things that are being looked at, and I think as well there's also been a analysis around if it's kind of a real estate heavy structure, do we need to bend and flex a little bit in terms of how we allocate across real estate? So if we've got too much in like leisure and retail, do we need to kind of shift out of that slightly and then go into some offices potentially? Also looking at real estate investment trusts, whereby we can shift out of maybe having one asset and get exposure to multiple assets in particular sectors. So logistics is one of quite a lot of interest with the rise of e-commerce continuing, and also talking a little bit into Liam's point around luxury assets, shifting out of some kind of real estate but then into luxury assets. So we've seen an uptick in interest in yachts and in aviation as well, which has kind of come about through the pandemic. So there's quite a lot of interesting trends, and it has been very insightful to see how it's kind of evolving.
Thank you. I mean, things like student housing and hotels were really badly hit in the teeth of the crisis. I mean, do clients and investors, contacts you deal with, think that those sectors that have been hit will rebound as soon as we get back to normal? Those assets will come good as long as they're probably financed and you're patient.
Sure. Yeah. I mean, interestingly, we had just as kind of COVID was striking, we were in the midst of a deal around some student accommodation. So there's a few kind of bumps in that road, but we ended up selling some student accommodation at a very good kind of profit. We're kind of still quite kind of bullish around student accommodation. I think it should rebound pretty well, and you kind of read things around potentially some of the sites which have maybe become distressed, maybe picked up and used for student accommodation. So I think there's good ability to kind of obtain that and then kind of lock in a nice kind of multiple in terms of the income yield.
Okay, thank you. We just got a question in the Q&A that I'm just going to bring up to Liam. Question from Ian Petts for you, Liam, just saying, I have a demand to look at new free ports in Southampton and Plymouth to diversify an investment portfolio. Is there demand from other clients to look at commercial properties within these zones and have prices uplifted? So just looking at, the way the government can incentivize and create free ports and things like that. Do you think that can be part of a broader government policy? These are things that are being thought about and created. Do you see any impact from that kind of thinking? I'm aware in the Northeast there's a variety of free ports and things like that being created.
Yeah, I think, look, in terms of the first part of the question, it's there is no doubt there is a significant interest and demand in the free port policy. And as a business, we've seen a significant uptick in requirements or people, I suppose, exploring the opportunities in the Freeport locations. In terms of the impact on value, I haven't got sort of hard and fast data on that, and I would guess it will be. I tell you what I can do. I can follow up this session and come back to you on that particular point. I'll check with our regional teams, but. That may be a little early to kind of get concrete evidence on, but the idea of ultimately the concept behind the Freeport policy is part of that wider government agenda, kind of as they've described, levelling up and kind of levelling up the regions, and these policies are having an impact in terms of regional markets, and you touched on earlier in your conversation around our overseas investors considering, or wealthy investors considering out of London markets and the regional markets. And we've seen the regional markets have kind of they kind of wax and wane in terms of their appeal to overseas investors and to kind of inward investment from overseas. At the moment, I think we're on a bit of a high in terms of demand for places like Birmingham, Manchester, and some of the regional markets, particularly the kind of the top tier regional markets. Primarily because I think actually Manchester and Birmingham have pulled so far ahead of the pack in terms of regional cities, in terms of their local economies. And the Birmingham story is becoming very strong in terms of not just the city actually, but sort of south of Birmingham and going towards Oxford, the kind of some of the science parks and business parks in that part of the world are seeing some significant investment. So I think there's a big opportunity in terms of regional investment. I think the free ports are part of that story, but it goes broader. But to the questioner's point, I think really government policy does have a big impact in terms of driving activity, but also driving investment.
Okay, thanks.
But I will come back on that value point.
Yeah, I'll connect you up with Ian, and you can take that forward. Just coming back to you, Mark. I mean, perhaps you could give us a sense for those who identify new acquisition targets. What sort of vehicles out of Jersey are they looking at along the spectrum, from more modest investments for high net worth clients through to more institutional grade structuring? What's the sort of palette of options that you just might discuss with a client, a family office, a sophisticated investor?
Sure. Well, I guess I guess to an extent, kind of no one structure is the same, and it's very much driven by their kind of tax position. But we do still see a lot of kind of holding companies with a Jersey SPV underneath. We see some co-investment vehicles, some joint venture arrangements. We've also seen obviously we had the kind of Jersey Property Unit Trust, which still kind of kick around to an extent. And the Jersey private fund regime. I mean, I think ones I see tend to be fairly traditional. So we're still very much in the standalone kind of company territory, with rolling up to either a trust or a private trust company at the top. And we do still see instances of shares in those companies being sold as part of part of an acquisition by another party. So that still does happen where it's relevant for the party buying.
Okay, so you're just looking carefully at the tax position where those investors are, what their individual position is, need for liquidity and things like that, and create the appropriate structure from there. So that's
absolutely, yeah. With people like Majid to the side, kind of advising us advising us carefully on our options.
And Majid, I mean, slightly adjacent question, but just those who've done well investing in property will end up at a certain point with an inheritance tax problem. Do you often see clients who've built these fantastic property portfolios then coming to the point that they need to actually wonder, how am I going to pass this on? The succession planning challenges, and those aren't obvious, are they? If they have assets pregnant with capital gains, it can be a real challenge to help them unpick all of that. Do you find that's a common scenario with the property investors who've done well?
Well, David, it all depends when they spoke to me actually in their journey. So, but broadly speaking, I mean, absolutely. I mean, capital gains tax and inheritance tax are still two huge pieces that form part of the discussions with clients. Interestingly enough, I mean, when ATED came about and the changes came about for inheritance tax in April 2017, I mean, you kind of hear the key headlines that trusts are dead. I mean, frankly, that's just not been the case. I mean, it's interesting, and again, echoing Mark's point, yes, it depends on the client, but there are still key considerations. I mean, clients or families that have that large family home in London, I mean, for those individuals, I mean, inheritance tax is going to be a huge issue. They're not looking to dispose of that house, that asset that's going to go through generations. So in those scenarios, we still see trusts as being quite useful. Clients, will stomach a 6% charge every 10 years rather than a 40% charge, which they just simply can't fund or have liquidity issues. So that, I think, remains quite key. The other point around commercial is whilst there's been all this discussion, a lot of noise around capital gains tax impacting commercial property, let's not forget, actually, it still can be exempt from inheritance tax depending on the domicile of the individual and how that's structured. So that still drives a slightly different structure in terms of trust, having overseas trust or having an underlying company. So there's still a lot out there. But no, you're absolutely right. It forms more of a discussion, but equally it actually leads to wider discussions around actually what are family objectives, what are the commercial objectives. So having that wider discussion about how we should structure, the acquisition and the disposing of property ultimately.
Thank you. Mark, I mean, the structuring piece is not all about tax, is it? I mean, it's about, perhaps setting up governance structures, a way of operating, a way of passing assets. So although we major in on property, perhaps UK property becoming less efficient, the structuring piece, that's only part of the overall picture, isn't it? So you still see clients, particularly in the Middle East, Far East, elsewhere, looking at the broader picture.
Absolutely, and the family, if you add the family dynamic to it, it's always a very interesting one, and particularly when you're kind of moving through the generations, and perhaps the next generation down have slightly different I guess kind of interests around what assets they'd like to see in the structure. So there may be some who are very kind of pro real estate or a hotel business, and others who are maybe more keen on a kind of a more passive approach through kind of investables. So when you get to that stage, you may find yourself having to look at a kind of restructuring so that you're able to cater for everyone, or you may have some structure where you have a kind of an all singing, all dancing structure, which feeds up into the different family members, and then they have their different segments. So it can one structure that you have over time can evolve quite significantly as the players change.
Thank you. And Liam, in terms of the attractive assets at the moment, like we mentioned with Mark, like logistics and things like that, I imagine it's hard to actually get these assets on a good price, as it were, now, because it's such an obvious trade. Or is there still pockets of value out there that people can take advantage of?
I think that's a really fair point. I think there are a certain number of sectors which have become very hot in terms of in interest. So logistics, data centers, even kind of medical kind of R&D properties, etc. I mean, there's a whole sort of range of markets which have really kind of seen a boost through the pandemic. And you're right, they are rare, and they're not easy to get hold of. And actually, things like, say, the data center market, which is a really big topic at the moment, is quite a difficult. It's not an easy market to actually sort of move into. These are properties which require significant amounts of expertise in terms of actually the development, the design, etc. You need specific requirements around access to energy supply, the actual sort of the capex on the buildings is significant. So it's not an easy kind of investment for many people. On the flip side, one of the obviously one of the markets which has been hard hit through the pandemic in terms of people's, I suppose, confidence around is obviously the office market, because we don't quite know how this lands once we come out of the lockdown. The one thing that does seem to be becoming clear is this kind of I can't even think what the word is. It bifurcation, so the divide in the market between best in class and kind of the rest of the marketplace. That corporates are basically making it very clear that the buildings that they want to occupy need to be absolutely best in class. And there's a couple of kind of trends there. One is the whole kind of ESG environmental agenda. Corporates have got to tick a lot of boxes at the moment, and actually if they've got green buildings to occupy, that ticks one of those boxes, so that's in demand. And the supply of best in class green energy efficient buildings is not particularly high right now, so there's a real opportunity there for developers and investors. And secondly, as we move into the kind of reopening and as employers try to attract their workers back into the office, guess what? Attractive, new, clean, whizzy offices are in demand, and that's where the demand is. So there's a big opportunity there, even in a sector like offices, which has got big uncertainty right now because there isn't the right type of stock available. And when you've got secondary stock in the office market, and there will be repricing in that sector undoubtedly, there's suddenly an opportunity to play around redevelopment and regeneration of those spaces. So there's a lot to go at the moment. I mean, and while some of these things haven't landed yet, we don't quite know what the kind of post-pandemic environment looks like. There will undoubtedly be opportunities in many of those even quite sort of vanilla property sectors.
Thank you. And just as we draw this conversation to a close, just want to bring Sarah May Brown back in from Knight Frank. Sarah, we heard from Majid, he's seeing more clients coming in to reside than to leave. When you're buying residential property with foreign investors, are you seeing the same thing? Are you seeing people choosing to make the UK their home, or investing from abroad and remaining abroad and visiting us a few times a year here? Do your thoughts concur with Majid?
We see both, obviously, and we've touched earlier on in the conversation on that sort of move to the country. Certainly, what we've seen of those international buyers who are already in the London market is certainly, they may well have followed suit at the top end of the market, followed suit and bought country residences. They're often at the very top end of the market. That's often an additional residence as opposed to necessarily moving out of the London home and out into the country. So that obviously has had a knock-on effect in terms of supply at the top end of the London market, particularly in houses rather than flats. To be honest, it's difficult to say as to whether we're seeing more people with the intention to reside. Perhaps. It's a hard one to quantify, actually, in all honesty. But we're certainly seeing in terms of demand from international buyers, it is certainly still, there's a lot of pent-up demand. People have obviously been readdressing their priorities in terms of home and lifestyle, without a doubt, alongside obviously all of the financial and wealth protection considerations. It's just actually one of the interesting things that we've seen over the last 12 months has been that not having the international buyers physically in the market has enabled real sort of surge in British buyers at the top end. So this sort of 10 million plus markets, there's been a real surge in acquisitions in the from British buyers here in the resident in the market.
And on the commercial side, if there are advisors on this call who have clients looking for opportunities, like Ian mentioning about certain opportunities, they can come to you to help navigate that part of the market for them, explore what the opportunities are, look at things in more detail. Is that right? Yeah, absolutely. Yeah, thank you. It's the private office team is both residentially and commercially focused. Exactly from a CRM perspective, you don't want to be
going around to so many different people. I suppose we sort of act as that conduit into big global firm, as I said at the beginning, you know, lots of different service lines. But yeah, they can, and we've got commercial private client experts sitting focus on private clients sitting within the private office team. So yeah, very happy to sort of receive any of those inquiries, and obviously see if we can help.
Terrific. Well, look, thank you for talking to us today. We're going to cut the line